Good morning, everyone. This is Marshall Giller bringing you the morning comment for January 27th. Sunday's election in Greece will have repercussions for the Eurozone for several months. In fact, given the impact that it may have on other countries' elections, it could be the defining event for Europe this year. Several other European countries have elections, particularly Spain, and Syriza's victory could encourage other anti-austerity parties in those countries and change the economic consensus in Europe. Now, the euro recovered somewhat yesterday, probably on a sell the rumor, buy the fact response, as the Syriza victory was expected, and the coalition with the relatively conservative independent Greek party reassured investors. Nonetheless, I believe there are more shocks in store for the FX market from the election. The new government reportedly has legislation ready to send to Parliament reversing some of the structural reforms implemented in the Troika program. I'm not sure how well that will sit with Greece's creditors. The legislation could disrupt Greece's exit from its 5-year bailout program, which expires at the end of February, and leave the country's banks without a liquidity backstop. Greek banks rely on the ECB for funding, but the ECB has warned it will stop providing liquidity unless Greece reaches a new agreement with its creditors. The implications for the euro are simple: bad, worse, and terrible. Please see the comment on our website for more details. Elsewhere, the Swiss franc weakened after the Greek election went as expected or even better, meaning there was less need for safe havens. Swissy may strengthen again in coming weeks, however, if tensions in Greece mount again. And the ruble collapsed after Standard & Poor's cut Russia's rating to junk. The rising tensions in Ukraine and talk of additional sanctions didn't help either. Today, the first estimate of UK fourth quarter GDP is expected to show an acceleration in the pace of growth in Britain. However, given the weak data from the UK recently, we wouldn't be surprised with a below consensus growth rate. That might be negative for the pound. In the US, we get durable goods orders for December. The headline figure and durable goods excluding transportation equipment are both estimated to rebound from the previous month, which should keep the dollar under pin. There are several other figures out in the US: the S&P Case-Shiller House Price Index, the Richmond Fed Manufacturing Index, Conference Board Consumer Index, and the preliminary market service sector PMI. Finally, in this morning's comment, I also look at tomorrow's FOMC meeting. There are two countervailing trends that the committee will have to deal with. On the one hand, domestic factors are improving faster than expected, particularly the labor market. On the other hand, overseas factors are going in the opposite direction quickly. Which should they focus on? In my experience, the Fed generally puts priority on the domestic economy, and so I don't expect any change in the language this month. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.